Good afternoon. My name is Ricardo, and we're going to be presenting to you guys case study 4, stock valuation at Ragan Inc. And we're group 6.
My name is Jose Ibarra.
My name is Stephanie.
And my name is Nicolette.
So this is our agenda for this presentation. We'll be giving a summary about the case study, and we'll be answering some questions regarding value per share of the company, an estimate of the stock price, also sharing information about the price earnings ratio, expressing relationships. Also, we will be talking about the future return on equity and make a strategy of the stock price.
So to quickly summarize the case, it's Ragan Inc., founded 9 years ago by siblings Carrington and Genevieve. The company specializes in manufacturing energy-efficient HVAC units. The company has grown rapidly due to its proprietary technology, which each sibling now owns 50,000 shares. Last year, Ragan Inc. reported an EPS of $4.54. They paid $60,000 in dividends to each sibling and had an ROE of 18%, with a required return of 15%. Compared to industry averages, EPS of 58 cents, DPS of 0.40 cents or 40 cents, stock prices of $13.09, and ROE of 12.33%. This company definitely stands out. Consultant Josh predicts their technological advantage will last 5 more years, after which growth will align with the industry. Both Carrington and Genevieve aim to increase the stock value without selling shares or increasing the debt. So for question 1, it's asking, assuming the company continues its current growth rate, what is the value of shares for the company stock? To find this, I first solved for dividends per share. I got $1.20. Then I solved for the payout ratio. I used dividends per share and I divided by the given EPS. I got 0.2643. The next step was to find the growth rate of the dividends itself. I used the given ROE and I plugged it into the formula there, and I got 13.24%. Lastly, I solved for the value per share. I had a key there. I have a key above the formula. I plugged in all the numbers and I ended up getting $77.31, and that equals the value per share of the company stock.
So for question 2, Josh wanted to see the company's financial statements as well as the competitors' financials. Josh believes that the inquired return used by the company is too high. Under this growth rate, what is your estimate of the stock price? So with our calculations for the company, we would have to go get the growth rate, then the industry average growth rate. Then we'll calculate the undivided growth and the present value of dividends, and also the value of the first 5 years. To estimate the stock price, we apply the company's growth rate and its dividends and calculate the present value of those dividends using the industry's growth rate. We then add the value, which is based on the 5th year of dividends and the growth rate. The final stock price is the total of the present value of the dividends plus the value as well. That's where I got the stock price for the company, which will be $41.89.
And moving over to question number 3. What is the industry's average price earnings ratio? What is the price earnings ratio for a Ragan Inc.? And what is the relationship that I would expect between these two ratios? For the industry average price rate ratio, I got 17.51 plus $8.60 and $12.46. After doing that, I divided by 3 to get a price earning ratio of $2,086.86. The price earning ratio for the Ragan Inc. Is equal to price per share divided by EPS, which is $77.27, and divided by 4.54 cents, which equals to 17.02 cents. But in my opinion, we should expect the relationship between these two to be the way it is currently, because Ragan has indeed better ROE of 18% compared to the industry average of 12.33%. To add on, it has higher EPS growth rate and of 13.24% as compared to the industry average of 7.89%. With these results, it shows us that the Ragan makes higher returns on every dollar invested in the business, and it would also offer better growth opportunities, in my opinion.
So for question 4, it asks, what does this expression imply about the relationship between dividends payout ratio, the required return on stock, and the company's ROE? So ultimately, if a company distributes more of its earnings as dividends, the discount rate will be higher, resulting in a lower stock price compared to a company with a lower dividends payout ratio. Also, if a company has a lower dividends payout ratio, it retains more earnings to reinvest and it generates higher returns for the shareholders. This leads to a lower discount rate, which will then increase the stock price compared to a company with a higher dividends payout ratio.
I'm Jasmine. I did question number 5. Assume the company's growth rate slows to the industry average in 5 years. What future return on equity does this imply, assuming a constant payout ratio? So to begin with, Ragan Inc. pays out all their earnings as dividends. Their payout is 100%. Their growth rate is 0%, which essentially means no earnings were retained for reinvestments. So for the industry growth rate, average return on equity is 12.33%. The industry average retention rate is 31.03%. Our calculations, or the formula we used, was G industry equals 12.33% times 0.3103 equals to 3.83%. So the future growth rate with 100% payout and the retention ratio at 0%, G future equals ROE future times 0 equals 0%, which basically means that there is no growth. So in conclusion, Ragan Inc. would need a payout ratio of less than 100% so they can achieve their future growth.
For question 6, after discussing the stock value with Josh Carrington and Genevieve agreed that they would like to increase the value of the company. Like many small business owners, they want to retain control of the company so they do not sell stock to outside investors. They also feel that the company's debt is at a manageable level and do not want to borrow money. How can they increase the price of stock, and are there any conditions under which the strategy would not increase the price of stock? So first, what Carrington and Genevieve can do to increase the stock would be increasing their dividends. By increasing dividends, they would boost up their stock prices. However, excessively high dividends can reduce the retention rate ratio for the company, which slows down the growth rate and lowers stock prices. Secondly, they can also focus on improving retained on earnings by budgeting or by effectively using management skills. Those are 2 ways to increase stock prices without outsourcing to other investors or adding debt to their budget. Thank you. That'll complete our